Hello, Sahil. Hi.
Hi.
We are live now.
Sure.
So, starting with your introduction, what Hello.
Hello. Yeah. I couldn't hear
We are
you
so sorry.
earlier.
We're facing a lot of network issues right now.
Okay.
But we'll start. We can start. Hello.
Yeah.
So, Sahil, let's start with your. We're talking about DSP's Nifty 500 FlexiCap Quality 30 Index Fund today, right? So, can you please walk us through what this fund is about, everything, all the details that our users want to know?
Sure. So, good morning. Thank you for having me. What I'll do is I will run you through a deck. I'll take about 15-20 minutes and take you through all the details of the fund. And I think that should set the tone, and then we can discuss any doubts if you have about the fund. And so, let me take you through the deck, which will simplify what this product is all about. So first of all, as you know, it's a new fund offer, NFO.
All right.
This is active from 8th of August to 22nd of August. It closes on 22nd of August. It's called the DSP Nifty 500 FlexiCap Quality 30 Index. First up, we'll talk about what the idea is. So mid and small cap versus large cap is sort of a cyclical play. Okay, so what happens is that when the market is in a very bullish phase, like we are right now, you will see that mid and small cap starts to trade at a very large premium, which means that a lot of market participants begins to think that mid and small cap stocks will become a source of great returns, and they start to price them very high. Uh, s- and the opposite happens in bear markets. So, for example, during the COVID decline or during the global financial crisis of 2008 or during the balance sheet problems in India, mid and small cap stocks become very, very cheap. Post the ILNFS fiasco in 2018, for about 2 years, mid and small cap underperformed large caps by a very wide margin. When these underperforming phases come, mid and small caps become very cheap relative to the overall market. So, for example, let's say the overall market is trading at 20, 23 times multiple, mid and small cap will start trading at a discount. But in a bull market, they will start trading at a very large premium. Now we questioned ourselves that when this cycle is so entrenched, and we have shown with data that this is not a new cycle, it's been there in almost all uh, stock markets across the world. In fact, in 1949, Ben Graham was writing about this cycle sitting in United States. So it occurs everywhere. And what is the source of this cycle? It is the typical greed and fear of the investor. So we found out with data that very smart active managers who, let's say, run the flexi cap funds, by using their skill set, they are able to capture these mispricing, where when small and mid caps become very cheap to when they become very expensive, they are able to capture this cycle. And this is the source of their additional returns, what we call alpha. So we questioned ourselves, can we create a formula-based investing mechanism or a passive index which can capture this alpha? And the FlexiCap 500 Quality 30 Index is actually designed to capture this alpha. It is designed to capture this skillful alpha that active managers capture by using a formula. I will show you that what that formula is, but this is the essence of what we are trying to do. This strategy is not based on, let's say, only backtesting some numbers and arriving at an optimized result. It is actually based on the first principles of investing, trying to capture the greed and fear of investors. And by doing so, we are deciding whether to be invested more in large caps or be invested more in mid and small cap. So we've divided this into two buckets. This is the flexi cap nature of the fund. So usually when you know look at the chart on your screen, you will find that when you look at the flexi cap active funds, most category funds are between 25 to, or let's say 22 to 38% in terms of their exposure to mid and small cap companies. But this index that we are talking about actually goes to 66.66% for mid and small cap. So this is like a true to label flexi cap fund. It is not only saying that I'll be in mid and small cap, it is actually taking a bet on mid and small caps when they become very cheap. Now, when you talk about, let's say, the active category or any other fund which has 65% plus large caps, it is nothing but a large cap fund. So this will give you a true to label flexi cap flavor in your portfolio. And that's why this is India's first flexi cap index fund. In fact, if you roam around globally, you will not find any flexi cap funds globally. The reason for that is that in other markets, the mid cap, small cap, and large cap definitions are not created. They are actually very, very subjective. In India, it's a very, very clear distinction, and therefore, this is India's first flexi cap index strategy, first flexi cap passive strategy. Also, flexi cap as a category is the largest category. It commands the highest AUM, and it has no passive offering as of today, except the one that we are launching now. Now, when you look at the strategy, it answers some of the questions. When you have a new 100 rupees to invest in equity, you usually have three questions. Where to put the money in large cap, mid cap, or small cap? How much do you want to allocate to these three categories? Third is, when will you switch from mid cap to small cap or from large cap to mid and small cap? What is the right time? What is the way to make the decision? And then you also face the problem of volatility. If you take these decisions and you churn your portfolio, you pay a lot of tax. This index will solve for all these problems. It answers your question of where should I put my money? In large cap, mid cap, small cap, this index will have the answer. How much should I put? This index will have the answer. How should I move from mid and small cap to large cap? It will answer that also. It will also take care of volatility because we are recommending our investor do a SIP only in this index fund. And the reason for recommending that is that it will take care of valuations and performance volatility. And last and most important, that this is a passive offering, therefore it is a low cost offering. It will add alpha to investors just because by the virtue of having a low cost strategy. Now let's look at how does this strategy work. This is the formula through which the strategy works. As you know the name, it's called Nifty 500 FlexiCap Quality 30 Index. I'll break it down very, very easily. So there are 500 stocks which are designated as large cap, mid cap, and small cap. What we are going to do is divide them into two buckets. One large cap bucket, which is stock number 1 to 100. The second bucket is stock number 101 to 500, which is called the mid and small cap. Or here we are calling them SMID, small and mid cap stocks, mids. This is the market jargon, right? So first large cap, the other bucket is small and mid cap, SMIDs. Now let's say that based on our flexi cap relative momentum formula, which is the underlying formula for this index, let's say that the formula says that put 67% allocation or two-third allocation to small and mid cap and one-third allocation to large cap. This is the decision number one, which is the market cap allocation. It could be the other way around also, where it could decide that put only one third in small and mid cap and two third in large caps, right? So this is the allocation decision. The index will always be either one third in small and mid cap or two third in small and mid cap and rest of the allocation to large cap. There are no in between allocations. So it's sort of a binary allocation call based on which is likely to do well. How does that formula work? I will tell you that in the next slide, but let me just clarify the structure. First, let's assume that the formula told us put two-third or 67% in small and mid cap and one-third in large cap. Then we'll go to the next step. We will select 10 stocks each from large cap quality index, which is Nifty 100 quality 30. This is the large cap index. 10 stocks each from mid cap and small cap index. So you get a total of 30 stocks which are filtered for quality. All these stocks are coming from the quality bucket, right? So all these are high quality companies. 10 largest high quality companies from each large cap, mid cap, and small cap. How will we make the allocation? The allocation call was made that two-third allocation should go to small and mid cap. So which means what it will do is that it will put one third money to large caps, one third each to small and mid cap. So total small and mid cap will go to 66.66% or two-third exposure to small and mid cap, one third exposure to large cap. This is the
Okay.
simple portfolio. Uh, at other times, what it will do is it will shift allocation. For example, let's say the formula says that go to large caps, then it will take large caps to 66.7% and reduce small and mid cap allocation to 33.33%. So this is the way that the index works. Now, what is the formula? Based on what formula is it taking the call of giving two-third to small and mid cap and one third to large cap? This is the formula. So what we did is we used a ratio of small and mid cap stocks, which is Nifty mid and small cap 400 index, which I said stock number 101 to 500. And the other is the large cap index or Nifty 100 index. We drew a ratio. You can see this blue line is the ratio. When this blue line is rising, it tells you that small and mid caps are outperforming large caps. That means they are rising more than large caps. When this line is falling, it tells you that small and mid caps are falling more than large caps. Now, as an investor, I know that when small and mid caps are rising faster, I want to have more allocation in small and mid caps, right? And when they are falling, I want to be in large caps. This is how the formula decides. What is the decision methodology? We drew a 200-day average of this blue line. Whenever this blue line is above its 200-day average, which means that it is higher, the allocation will go to small and mid cap. So, for example, take a look at this category where we are sitting in, let's say, April 2024. The blue line is above its 200-day average. The index will put two-third or 67% approximately to small and mid-cap stocks. And as you can see, post the COVID era, small and mid-caps have outperformed large caps, and this index, at least on 70% of the time scale, was sitting in small and mid-cap stocks, which was adding a lot of alpha to it. Whenever the markets fall, for example, post INFS, small and mid cap fell significantly. At that time, you can see the index was sitting largely in large caps. It was avoiding small and mid cap stocks, which added more returns to the index. This is the simple formula. Three-pronged strategy we are using. One, using a FlexiCap relative momentum to take allocation decisions. Second, selecting companies based on quality matrix. So only high quality companies will come. Third, using concentration by creating only a 30 stock index and not a 50, 100, 200 stock index. And fourth, and most important, it's a equal weight strategy where all stocks are weighted equally based on allocation to the segment. And as we've known, historically, equal weight strategy works very, very well. This is the historical returns of this index. You can see the Nifty 500, which is sort of the base index, has given 13% CAGR over the last 16 years. This index has delivered 18.1% CAGR, so about a 5% alpha on this index. The source of alpha is from FlexiCap relative momentum, the quality selection, and the concentration that we are doing based on equal weights, right? All three categories add to alpha, add to your return. Historically, we've seen that why we are using quality right now. Quality had 5 bad years, and we believe that it is the right time where you should invest in quality. And why? Most of the DSP offerings come when the particular strategy is underperforming. And why do we do that? Because it is very easy to sell outperformers. Investors pay a lot of attention to recent results and they put a lot of money. we are telling investors to look at strategies which are underperforming in the short term, which will help them have a better experience when they actually put that money. And why will that happen? Because of the simple concept of mean reversion, right? All factors, which is quality or momentum or concentration, mean revert. Currently, this factor is having a bad time, which gives us a lot of confidence that investors can have a good time. We don't know whether this is the best time or not, but it is surely a good time to invest in high quality companies. This is various phases across which this how this strategy has performed. Across all bull and bear markets, this strategy has delivered outperformance. And the reason for doing that is that this strategy plays on the greed and fear of the market, tries to avoid tries to avoid when markets are exuberant. It goes and sits in high quality large cap companies. And when the market is very fearful, it goes and sits in high quality small and mid cap. That becomes a high source of alpha, right? Plus, as you know, the qualities factor we are using here gives a very high return on equity to the portfolio, which means that the portfolio's quality is very, very high. If we solve for valuations, which we are solving through by launching it at a time when it is not doing so well, it gives us a lot of confidence that over a period of time, the quality factor will mean revert and the experience for investors will be better. Um, the next is that we compare this strategy to various type of strategies. So, for example, if you compare this strategy to the broader market, which is the NSE 500, it has delivered 13% return over the last 16 years. Now, think about a person who has foresight. That person knows in advance that which index will do well, whether it is small cap, mid cap, or large cap. That person can pick the winner before they occur. That person would have earned 22.9%. This is a fictitious imaginary person. Nobody can time the market so well, right? We've calculated the odds. It is 1 in 130 million. So it is almost not possible. But look at other types of investor. One, performance chaser. Lot of investors fall in this category. What they do is that whatever is doing well, they put money there. These type of investors underperform the broader market. You can see that they have underperformed by 50 basis points, the Nifty 500 universe. Then there are contrarian investors. What they do is that they put their money, which is the most underperforming asset. They have beaten the market handsomely, right? And then there is equal weight investing, which is also done handsomely well. But look at the FlexiCap Quality 30. It gets very close to the frontier of what is possible by using first principles of investing. And therefore, we feel that this strategy is a very durable long-term strategy for investors to play with. Why we are launching right now? As I told you earlier, at this point in time, this strategy is at one of its lowest rolling 3-year alpha versus the broader market. We are not launching it here. It is very easy to launch funds when they are doing exceedingly well because recent returns look very, very, juicy. Investors are attracted towards it, but we want to launch it when it is not doing so well. Then the reason for that is that these things mean revert, and when they mean revert, investors will have a better experience. Here, when you have already done so well, investors tend to invest a lot, but their experience becomes very, very sour as the strategy underperforms. We have taken care of this underperformance phase. We formed this strategy last year, about 12 months ago, and we waited for an opportune time for this to underperform so that we can launch it. Uh, what we are saying is that we recommend that investors use the SIP route to invest in this strategy. And why we are saying that? Imagine that if you were an investor between January 2008 and March 2014, Nifty delivered 0% returns. It delivered nothing. But a SIP investors made 9.6% return. And why did that happen? Because when the markets fell, a SIP investor was able to add more units. It was able to buy more units at a lower NAV. And when the markets went back to their previous high, the investor had a much better outcome. So what we are telling investors is that this strategy solves for what to buy, large cap, mid cap, or small cap, how much to buy by taking the allocation decision. To solve for valuation and timing, the investors should come in with a SIP. And if they come in with a SIP, this could become a forever type of a strategy where they can invest and forget about it because it continues to deliver decent returns, which can help investors stay invested for a very long period of time. So this is the brief about the strategy. I will stop here, and if there are any questions, I'm happy to take them. Thank you. Yeah, back to you.
Hi, thank you so much for your walkthrough. I have a couple of questions, and our audience who are watching, I think they also have. But starting with, you already touched upon a lot of points. But still, my first question to you would be: you said this is the first passive flexi cap fund
Yeah,
in India. So, what was the inspiration behind launching this or bringing this? Like, what is the like? What made you? What is the idea behind this? You already touched upon it, but again.
sure. See, first thing is that a lot of investors, when they come to the equity market, they think about what to buy, mid cap, small cap, large cap, right? This is a question, and most often than not, they end up buying three or four different type of funds, right? And when the one is not doing well, they come and churn the portfolio. They will sell the underperformer and buy the outperformer, leading to two very basic mistakes. One, tax outgo, and second is that chasing performance that causes them to underperform. So we said that how can we solve it? If investors are picking three or four funds at one go, can one fund solve for it, right? Second reason for launching this kind of a strategy was that currently there are no flexi cap passives. When you look at the large cap space, large cap passives are bigger than large cap active funds, which means that investors have already embraced passive investing in large cap. So is the case with lot of mid and small cap investing, lot of factor investing schemes which are going on. Flexi cap being the most favored category in the industry, a lot of people understand they want to buy big, small, and medium sized companies. So this is one of the offerings which can solve for this problem.
Also, since it's a passive fund, can you tell us how it's going to be managed?
Yeah. So passive funds are managed using a underlying index. So this index, which is called Nifty 500 FlexiCap Quality 30 Index, is made by NSE, and we are going to follow whatever that index does on a quarterly basis. So at the end of each quarter, the index will go through a rebalancing, which means the weightages of stocks will be redecided on every quarter end, and every 6 months there will be a reconstitution, which means that the number of the type of companies or the name of companies will be decided every 6 months. So this is decided by NSE. It's a passive strategy. DSP is only going to follow this strategy, and no discretionary decisions will be made at the end of DSP Mutual Fund. It's a passive fund. It will continue to follow the index strategy. You can think about it in this way: just like Nifty 50 is an index which is very transparent and available to all of you. Nifty 500 FlexiCap Quality 30 is also such index which will be transparent and available to all investors.
Okay. So, my next question to you would be for someone who's already holding FlexiCap fund. Okay, they are invested. They have invested in FlexiCap funds. What is that one thing that okay different that they will get in this fund? Why should they switch or maybe invest here?
First thing is that I will never tell investors to switch. And the reason is that when they switch, they will have a tax out. So think about it this way, that if you are interested in the FlexiCap category itself, this is a low cost alternative. It automatically saves about a percent of cost. Second thing is that no FlexiCap is actually a FlexiCap. I showed you with data that most FlexiCap active funds are actually investing only 25% or 35% in small and mid cap. So they are effectively large cap plus kind of funds, right? So if you truly want that flavor in terms of mid and small cap, this is the place to be, where this fund will actually go to small and mid caps in a sizable manner. Third thing is that imagine that you started a flexi cap fund. You also bought, let's say, two or three flexi cap funds. Now, after 10 years, you realize that you want to switch from one fund to another. You will have a very large tax outgo, right? Or let's say you decided on large cap, mid cap, and small cap, and after 5 years, you think that I want to be only in large cap, or I want to be only in mid and small cap. The moment you make that decision, you will have a tax outgo. Second problem is, how do you make that decision? Right? You need to have some basis for making that decision. Think about this index. It will not only make this decision based on the formula which I showed you, it will also not give you any tax outgo, which means that after 5 years, if the index moves from mid and small cap to large cap, you will not face any tax outgo because the strategy will account for that internally. I think these are two very, very powerful use cases for investors to choose passive flexi caps.
So, Sahil, you already talked about allocation across market caps. But once again, if I ask you to briefly tell us how across small, mid, and large cap, how the allocation is going to work, and then just briefly, once
Sure.
again.
Sure. So as I told you that there are two buckets. Think about it like this. There are two buckets. One bucket is large cap stocks. The second bucket is small and mid cap stocks. We are saying that whenever small and mid cap stocks are doing well, we want to be invested with a higher allocation. Let's say 66% or 67% in small and mid cap stocks when they are going to do well. How we are going to decide
Okay.
it based on the formula which I showed you. If small and mid cap stocks are
Mhm.
outperforming large cap, we will put 67% in small and mid cap stocks. And how do we decide that outperformance? The 200 DMA average of the ratio of SMID divided by large cap, right? And when they are not doing well, the index will move to large cap. This is a simple allocation strategy um, based on which it will allocate funds, and it will have a very smooth journey, quarterly rebalance, as I told you, and 6 months reconstitution.
Can you also shed some light on how the rebalancing will work, how it will be done?
Sure. So let's imagine that we are sitting in August, any particular date, let's say on 18th August today, and on 30th September, NSA will publish a fresh index constituent list for Nifty FlexiCap 500 Quality 30 index. It will also give fresh weightages based on whatever has happened in that quarter. So based on that list, the allocation and stock decisions will be taken. So that is how rebalancing works. And then for 3 months, the index will work on the same constituents and same index. There will be no change. And then again, a rebalance will come. And that is how every quarter rebalancing will be done. And because it's a passive strategy, the churn usually happens only on that particular day. So versus a lot of other strategies, for example, a high churn momentum strategy, this will have a much lower churn rate also.
Okay. So my next query would be, what does the exit load and expense ratio for this fund look like?
So expense ratio for the regular plan will be about 1%, and for the direct plan will be about 30 basis points. So it is truly low cost. Second is there is no exit load. This is an index, passive index fund. It
Okay.
doesn't have any exit load. And also the minimum investment is about 100 rupees. You can start with as low as 100 rupees in this fund.
Okay. You also mentioned that people should prefer SIP over lump sum here. So I'm again asking you to maybe explain what is the rationale behind that.
Sure.
Just once
So
again.
there are two reasons for it. First is that, as you know, that small and mid cap valuations are not very cheap. India as an equity market is trading at high valuation. So if you want to solve for that problem, SIP is the best route, where SIP will give you a much smoother journey. Second thing is, as I said, when you look at the overall construct of the fund, if you are a very long-term investor, we've seen over a period of time, even when markets don't do so well, SIP gives you better outcomes, right? In a outright bull market, SIP works very well, more or less matches the lump sum. If the market is sideways, SIP does exceedingly well,
Hmm.
outperforming lump sum investments. Let's say if we enter a bear market also, SIP helps you lower your cost of each unit, and therefore it performs very well. And therefore, I think based on the strategy that we are working on, where we are going to invest in large, mid, and small, SIP is a much cleaner strategy today, based on two things, as I said, valuations and taking care of the volatility of performance for investors.
So what is the minimum amount one can invest here?
As I said, it's 100 rupees. The minimum investment
Okay.
amount allowed in this fund is 100 rupees.
And if I were to ask you who is the ideal investor for this fund, or maybe what would be your answer?
See, as I said, in FlexiCap category, that is the largest category today. So, which means that a lot of investors are already choosing a FlexiCap flavor when they invest their funds, right? So, it is widely acceptable as a category, and therefore this fund is also very useful for most type of investors, right? Investors which have a very short-term horizon of 6 months, 1 year, who are tactical in nature, you can exclude them. This strategy is not for them. But for truly long-term investors who are looking to invest and stay invested and benefit from all type of large, mid, and small companies, I think it's an ideal strategy.
Okay. So you already have touched upon uh, how the returns will look like. But if you can once again tell us what can an investor expect expected returns, or how what will it look like?
See, there is no way to judge the future expected returns. I think there is
Yeah.
no formula. Historically, this index has delivered a 5% alpha over Nifty 500 over the last 16 years. That is what the data says. Second thing is that because these are high quality companies which have higher ROE, the portfolio ROE is about 20% or so. If the companies are able to demonstrate earnings growth, what they have done between, let's say, 10 to 12%, and continue to trade at the multiples that they are, I think investors can expect to do equal or better than the broader market in this strategy.
So our users, they are also, they have a couple of questions. One would be, Mr. Bansi asks, please let me know the expense ratio and would there be an AUM limit?
Yeah, sure. There is no AUM limit. It's an open-ended fund, so you can invest whenever you want to. Expense ratio, as I said, for the regular plan, it will be 1%, and for the direct plan, it will be 30 basis points, 0.3%.
Okay, let me check another query do we have. I think that would be it. We don't have many queries right now.
Sure.
Just give me a minute. That would be it, Sahil.
Sure.
We're not getting a lot of queries right now, but
Sure.
I think you touched upon everything that was there, and मुझे भी जो confusions थे मैंने आपसे पूछ लिए, and मेरे
Sure.
लिए तो clear हो गया है. I think people who are watching उनको भी काफी clarity मिल गई होगी.
Sure. Thank you very much.
And
Thank you for having me.
thank you, Sahil, joining. Welcome. Thank you very much, first of all, for talking to us, for making the time. Mm.
Okay. Thank you.
Thank you. Bye bye.
Bye.